All right. Let's see. Get the socials going. All right. I'm going to start here. Hello, Smart Money Tea Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with my good friend Doug Hagren. Hey, Doug.
Well, I'm halfway there, Kirk. I'm here. I have some camera issues, tech issues. Don't know what's going on, but people didn't come for my face. So, but I am happy to say that my son has just turned 13 years old. So we've got a birthday coming up. I got another teenager in the house for all you out there that can relate. Welcome. I've got two now. Crazy time.
Nice. Well, congratulations, man. You were the ghost of the machine today without the voice without a picture. You are you got a face for radio, Doug.
Apparently so, and officially so today. So, but that's not going to stop us. So we're going to keep rolling as long as we can get on. We can get going. So.
Yeah. All right. We'll get started. Well, for those of you audio viewers, you might have missed, but I'm wearing my tinfoil hat today to start the show, just in honor of just the all of the social norms and things that you think are real. I just have to point this out because we've been bombarded with all this stuff in the last 12 months, especially since the Epstein files released, but. All I have to say is it sounds like Alex Jones is right. I mean, Epstein pedophile ring, Pizzagate, globalists, UFOs, global warming, lab leaks, Hunter laptop, the government not suppressing the First Amendment, WEF eating bugs, happy owning nothing, the Great Reset, vaccines, chemtrails, weather manipulation, geoengineering, MK Ultra. Doug, are we living in a flat Earth?
I think
that's true. I don't know.
I think we can officially say that the simulation is real.
Yeah, I think so. I think the simulation had a bug, and we all see it. The reptilian lizard people are living on the moon that we've never visited. Oh, sorry, I had to just say that because every once in a while, people talk about conspiracy theories, and everyone says, "Well, you're just a tinfoil hatter," and you always have to wonder, yeah, but why do people really believe that? Okay, QAnon, all that stuff, great, but now when you start to see it come out where some of this stuff is actually true, you're like, huh, what else is true?
Anybody feel like pizza tonight?
No, yeah, pizza and grape soda. No, I'm good. Yeah, so all those shenanigans, I just shake my head and say, God, all the things we wonder, are they true or not? Now it's got you really scratching your head. What else is questionable? To be fair, when talk about UFOs, that's been going around for a while, and I don't know if it's tinfoil hat anymore. It's gotten to the point where politicians are coming out and saying, yeah, something going on. So I just wonder whether it's whether it's a psyop or whether it's real. You always have to wonder whether things are psyops. But anyway, we're not going to talk about that stuff all day. I just wanted to bring it out. I had to say it because it was so crazy that we've gotten to the point where I can't ignore the fact that it's just our realm of what we think reality has been cracked and is starting to shatter in front of our eyes. So I want to say that as kind of a segue into other stuff we're going to be talking about, because there's some other things that are shattering in front of our eyes. And one of that is the understanding that you just buy the Mag 7 and forget it. I mean, that trade's been going on for quite some time. I would say at least 15 years. It's been tech or bust, and just buy tech and you're all set. Yeah, it's volatile, but everything else has just been on the sidelines. And that's just not true anymore. Tech has not done well in recently. I think I'm going to share a few charts here today because they've been interesting to me. One of them is this chart. This is breaking down each sector in comparison to the S&P. Looking at the S&P returns, this is as of the 13th. Today is the 20th. And as of the 20th, I think the S&P is up 0.3% for the year. So it's a real head scratcher for the first of the year, not going very far. But if you look at the best performing sectors, you have energy, materials, and staples. The worst performing are discretionary, technology, and financials. Technology is down 3% this year. I'm actually shocked it's not down more, frankly. But you have semiconductors keeping it up. If you look at things like software, I think software this year is down. I think it started the year. I think it's down about 20%, somewhere thereabouts. The software alone, just the start of the year. I think from the peak, it's probably down closer to 30 or 40. But yeah, tech is not leading the way. Now, I say that, and I'm going to share this chart with you because it's important. Now, remember we said, what are the best performers? Energy, materials, staples. Well, let's look at this map. So this map is basically an overlay of the market versus the economy. So if you look here, the red is the market. It's the cycles of the market, the ups and downs, and the economy is in blue. Now you notice the blue is a little bit to the right shifted. Now what that means is the market precedes the changes in the economy. So if the market's at a bottom, usually we're still in recession for the economy, but the market starts to pick up well before recovery. And the market tends to fall off before the economy starts to sell off. So it's important to understand these dynamics as an investor. Unfortunately, we've been in this weird cycle for 15 years where it hasn't been a market cycle. It's just everything goes up all the time. But as we've started to see, tech is no longer leading the way. And we could be back into a quote unquote normal-ish economy where the economy rotates. And, we had tech, people forgot things rotate because they weren't rotating. They were just sitting, the needle was firmly pressed 100% to tech. But if you look here, let's see, what did we see? Energy, materials, and staples. Well, let's look here. Energy, materials, and staples right here, market top. So according to the sector rotation of the markets, the things that do well at market tops, materials, energy, and staples. Okay. What are the worst performers? Worst performers, financials, technology, discretionary. Okay. Technology, financials, discretionary. They don't all seem to be here, but if here it is. So if you look here, those do well at a market bottom. We're the exact opposite end of the spectrum. So right now, what it looks like is we're at a market top, which makes sense considering the S&P and the NASDAQ have gone sideways for quite some time. They're in a channel. They haven't really gone up, but they seem to be showing like a market topping pattern. And this is the kind of thing that happens. When markets go sideways, they're either going one of two ways. They're either going higher or they're going lower. Now, when markets go sideways, sometimes it's they're burning off energy so they can go higher. Sometimes it's because it's a topping pattern and they're going to go lower. We don't know which one it is, and you can speculate all you want, but you're not going to know because we don't know the future. But we'll know when it goes in one direction versus the other. So at the moment, we're at a topping pattern according to the outperforming sectors. Well, the sectors that'll do well as we head into a bear market will continue to be energy. Staples will continue to do well, and healthcare should start to pick up. Well, healthcare hasn't done a whole heck of a lot, so I don't think we're into the bear market territory yet. But you should understand these cycles because if you at one point knew them, you probably forgot because it's been so long since they've been applicable. But if you're new to this, you should really understand this because this is a new skill set you're going to need to learn because this is how markets operate when they're not being highly manipulated by the Fed, which they have been for quite some time. And they still are, but within reason, we hope these cycles start to get back to normal. So I think it's an important framework to understand how these things operate. I'm going to give you one more framework, and then we're going to head to Doug. And the framework is this. We've talked about this before, but if you look at a presidential term going back 100 years or so, now, if you go back 100 years or so, you look at presidential cycles. I think this went back to 1950, but I think it holds true pretty much if you go back 100 years. And these two charts show the 4-year presidential cycle. So there are 4 separate years. The first year tends to do well. That's very normal for a presidential cycle. The first year does well. Normally, the second year does not do well. It is the worst of the four. Now, it doesn't mean it's going to crash. It doesn't mean that, people are going to be jumping out of windows. It just means that compared to the other three, it's the worst. Now, if you see here in this chart, in the top chart, you see the first year does great. The third year does awesome. And the fourth year does well. So the third year is the best, clearly. And it really starts about the beginning of Q4 until about mid Q3. Oh, we lose you?
No, I'm still here.
Okay, you're still there. Okay.
Yeah.
So really we have pretty much from the beginning of this year until about the beginning of Q4, you can expect a very mediocre performance. And so far, that's been correct. The Dow, not the Dow, I don't really follow, nobody follows the Dow, but if you look at the S&P, the S&P has basically gone sideways since pretty much Q4. If you look at the NASDAQ has gone sideways pretty much since Q4. So actually, this is pretty much in line with what you would expect for a normal presidential cycle. And, we should expect a little bit of a blip up over in March and April, and then you should probably see it slide down until about October or September, October. So this is within line of expectations, and you should understand that. Now, does this mean this is exactly what's going to happen? No. But the probabilities say it is. So you have to look at markets because we can't tell the future from a probabilistic standpoint. What is the probability it's going to do X? Well, we can look at history and say the probabilities are high that this is going to happen. But we don't know. Anything could happen. It could go a lot higher. It could go a lot higher. We have no idea. My guess is it's probably going to follow this normal cycle. Now, if you look at the bottom chart, it shows the second year, or we call the midterm year. This is where the elections happen. So we're getting the end of September, early October. Then you start to see the rocket ship ride. So you pretty much have till April, and then mid-April down. It goes down into the summer, and then it goes sideways, and then comes back up. So far, it's just been flat. It hasn't done the typical cycle. I thought we would go down in February. So far, it's just gone sideways. I think we actually need a sell-off. We need a 10% sell-off at this point. We haven't seen one yet, but actually, if you look at, see if I can find it here. I had one of these. Here is another probabilistic thing I want to share. And it's since 1950, average midterm drawdown is 18%. Since 2000, it's been 19%. All years average about 13%. This is a midterm drawdown. Okay. Now the frequency of 10% corrections, about 70% of midterm years have corrections. So we should expect the market's going to sell off 10% at some point this year. Don't know when it is, but you should expect it. So if it happens, don't freak out. Don't think the world's ending. Don't think we're going to have a market crash. Just say, okay, this is normal. Move on. Nothing to see here. So I think those are just some things to keep in mind. We are definitely a little bit bearish right now. We're starting to see some things happen. Software is sold off. Big tech is sold off. For some reason, the NASDAQ, although I've done the math, it is what it is. But the NASDAQ has not sold off as much as it probably should have. And the S&P certainly hasn't as much as it should have. But we are seeing rotation. This is actually a healthy market, despite the fact that everything's expensive and overvalued. It is very healthy. So all that being said, what should you take away from this? Here should be your takeaways. Look at the sectors doing well and think about, well, do you think they should continue doing well? I think that's highly possible. Staples, love staples. Materials have done well up till now. I'm not sure if that'll continue because we had a big run. Energy, we'll see. Apparently, we're going to attack Iran on Saturday. You know how Trump likes to advertise his what he's going to do. So my guess is it's not going to happen. We'll see. But I think a lot of people are expecting that. So I think if that doesn't happen on Saturday, then we might expect oil to drop. But overall, the way I'm looking at things is we should be looking at the boring parts of the economy, the things that put you to sleep. you could look at Procter and Gamble, Johnson Johnson, like toilet paper. You can, you can look at the basic essentials of life, diapers, toilet paper, those kind of things people are still going to buy. And if you're looking for safe stocks you can look at Walmart, Costco, those are big staples. Companies like that, you should look at and say, all right, well, what can continue to do well while these other sectors are taking a break. So I don't know. What are your thoughts, Doug?
All right, let's get that mute off. First of all, you can't see me talking, but at least I thought I'd put something pretty up there for you, Kirk, so you can feel that you're not doing this alone.
This is the best side of it.
I don't know if it is or not. Yeah, no, the presidential cycle, I mean, here's the big picture. The presidential cycle is a liquidity story. Generally, year one, you're going post-election, you're going to see choppy and digestion. Year two, the midterm year, often a weak first half, bottom into fall, but year three, pre-election year, the strongest year on average, and year four, election year, positive but more volatile. And it's not magic; it's generally policy incentives. And those administrations, historically tighten early if needed. They absorb pain before midterms, which you're kind of seeing some of the talk change, this year as they know elections are coming up. Stimulate ahead of elections, and it's often about timing of liquidity and fiscal tone. It is an astrology. And what it's suggesting, like you said, weak Q1, Q2, which is historically, what you get in midterm years. The bottom is often going to come sometime in late summer to early fall, and then a strong rally into year 10. And that pattern has shown up repeatedly since World War II. And the chart shows 2026 currently tracking the softer earlier phase. You mentioned a 10% pullback. Here's a reason not to get concerned about a 10% pullback. They've done studies. I can't remember if this is from Oppenheimer or which is no longer, they've been absorbed. I forget, Chase, a number of organizations have done these studies that show that it's very common in almost every year to at some point get up to a 14% pullback. So, 10% would put you well within, a nothing burger. Now, the critical nuance to keep in mind with this is that the pattern works best when inflation is not structurally high, when the Fed has room to ease, when there's fiscal policy that can stimulate. Right now, we've actually got some things that are headwinds. Inflation is sticky, debt levels are extreme, the Fed is constrained, and policy uncertainty is elevated. And so that could weaken the reliability of the historical cycle. And so, a couple things to think about, with this, as I mentioned, presidential cycles, liquidity cycle in disguise. It's not about politics. It's about when policy, makers are willing to tolerate pain. Midterms typically tighten liquidity. You get policy uncertainty. Market weakness does show up because administrations would rather absorb market pain now than going into the election year. And that's not theory, that's incentive structure. But the thing is, we're in a historically weak window. But this isn't a normal cycle. Often, as I said, we see the sell-off in summer, bottom late Q3, hard into year end. But previous midterm cycles, Kirk, didn't start with 120% debt to GDP, sticky inflation, massive treasury issuance, a new Fed chair. This isn't 2010. It's not 2014. It's not 2018. The pattern could work, but people have to understand there's headwinds that we didn't have before. The real question, real story is if the cycle fails. If the markets don't bottom into late summer this year, it could tell you something bigger. It could mean that liquidity is structurally tighter. Debt servicing is crowding out stimulus. The Fed doesn't have room to rescue. And that would potentially signal regime shift, not a seasonal anomaly. I would say that markets are weak right now, too, because policy wants them weak. Nobody's saying this out loud, but there's tight financial conditions that cool inflation. Softer asset prices cool excess speculation, and economic pain early is politically survivable. So asset deflation now is going to end up being politically safer than inflation later. That's uncomfortable, but it's realistic. The real rally comes in year 3 if we can make it there clean. And historically, pre-election year is the strongest of the four because of stimulus ramps, tone shift pro-growth, fiscal generosity increases. If we can get through 2026 without structural damage, 2027 could be really powerful. But if we don't, then that strength's going to potentially get, very muted. So these years, these midterm years, they tend to expose fragility. And so it won't be unexpected to see volatility spikes, risk rotation, which we're already starting to see, leadership changes, not necessarily weakness, that's stress testing. And we're already starting to see narrow leadership, small cap lag, layoff headlines, cross asset volatility. All of that kind of fits the pattern. But the thing is the calendar isn't what's going to save you. Liquidity will. And I believe this is the important part. Presidential cycles aren't going to drive the markets. Liquidity is. And the cycle works when liquidity cooperates. If we see liquidity tighten, the cycle's going to fail. And we're really sitting in a rotation market, not a collapse market. There's nothing in the charts that shows systematic breakdowns. What they're showing is growth's giving way, defensive stability, volatility digestion. That's more within the rotational midterm pattern. It's not 2008. It's also not 2020, although they want to tell us that there's another illness going around here and there. I would say if I had to pick a time that this fits to me, it's more like that 2011 style churn. And that's unless, we see the credit crack. Where I do see some exposure, the wealthy, I think, are going to end up being more exposed to this cycle than they realize. Affluent portfolios tend to be more risk tolerant. That means that they're going to be more growth heavy, often more tech concentrated, more passive weighted, and midterm weakness could disproportionately impact duration assets, high multiple stocks, over concentration portfolios. I believe that's where it's going to be important to look at asset mapping and rotation matter. And ultimately, I'll just, hand it back to you. But, from this standpoint, the presidential cycle says volatility now, strength later. Debt, inflation, liquidity will determine where the script, whether the script still works. And if the market bottoms into fall, history is going to win. And if it doesn't, regime change will.
Yeah, I think it's going to be a really interesting year. We are very strongly in the camp of kind of our thesis, which is Trump wants to retain power, right? If he doesn't, he's going to be bogged down with getting censured and, they're going to be coming after him for the next 2 years and he'll get nothing done, right? Which is what the other party wants. Which is kind of ridiculous, but whatever. That's the politics we've found ourselves in. So, Trump more than anything wants to retain power. So let's say that's my base case thesis. Okay. You don't have to like him, right? We're not talking about whether you like Trump or not, right? Because I know some people don't, a lot of people do. That's how we get elected. But let's talk through the thesis, okay? Because when you're an investor, this is how you need to think about things. So my base case thesis is Trump wants to retain power. Okay. So in order for him to do that, what has to happen? Because the probability is such that he's not going to retain power. If you look at election cycles, Democrats, Republicans, they almost never retain power. Like, I can't remember the last time it happened. I'm not a historian in this, but a while ago I read through this, and I think it's been like over 50 years since that's happened. So the probability is such that it's not going to happen. But if he did want to make it happen, what would have to happen? Well, what are people concerned about? Well, they elected him on certain aspects, so they want to make sure that those things are being met. Now, some of them have, some haven't, right? He was I'm going to get out of war as president, yet we've gotten into a few. He's got out of a few, we got into a few, so I would say it's probably lukewarm on that. I'd say probably maybe slightly negative in most minds. Certainly me. I don't want to go to more wars. What else do you have? Well, you have the price of goods and services. Well, you still have the K-shaped economy, right? That started in the last 4 years or 5 years, and it's still going. So, if Trump wants to make people happy, he has to help the people at the lower end of the K. Well, how do you do that? Well, you reduce the price of goods and services they pay every day. You reduce the price of electricity. You reduce the price of oil and gas, so they can, put gas in their car. You reduce the price of rent. You reduce the price of mortgages. If you think of all the things that people in the bottom half of the K have, it's daily living. They're not going on trips to Bora Bora. They're just trying to put gas in the tanks and get to work. So what is going to make those people happy? Well, if their mortgage rates, if they can cut their mortgage rates by a full percent, by dropping mortgages by a full percent, which I think is going to happen, then they can refinance. Now it's cheaper payments. What about a 50-year mortgage? Well, that's definitely going to reduce payments. We're not talking about whether it's a good idea. I'm just talking about the bare essentials of politics. Okay, I can get a cheaper mortgage. Great. Cheaper rent. That would be great. Cheaper electricity. I don't know how they're going to do that, but okay. Cheaper gas in my car. They can do that. They just keep gas prices down. And if you don't think they can do that, they can. Every president, every politician does this. Oil and gas prices are a political commodity. They always have been. That's why I don't invest in them, because it's based on politics that I can't predict, because I don't know what so-and-so is going to do. So some people are good at this, but it's not my expertise, so I don't try to be. Now, what I do know is that that oil prices are low. I have pretty low gas prices at the pump right now. I love it. You should love it too. I don't think it'll stay there forever, but at the moment it's the case. Well, what about inflation? Everybody's worried about inflation. Well, actually, inflation is kind of low. If anything, I think we're borderline deflation. We had a big spike in inflation, and then it's come down, and it's still going. So if you look at some of the numbers I look at, you see, wow, we're borderline deflation. And that's including the fact that European countries around the world are exporting their inflation to us right now. And yet we're still in deflation. That's a potential problem. What's that going to look like? You better start owning bonds. I'll tell you that much if that takes hold. Because you want to get that income when everything else is declining in value. Now, okay, so if that's my thesis and I'm proven correct, then you should be looking at certain areas, right? What is going to do well in these areas? Well, fixed income should do well if rates drop. Mortgages goes down. That means the 10-year is going to drop. Probably the 30-year is going to drop. Right now, they're not dropping interest rates from the Fed, which is borderline criminal. I think I'm just going to make this statement and I'll move on. A lot of people say end the Fed. I think, frankly, I'm not sure what the better solution is. I'm all in favor of that, but I don't know what the better solution is. But I can tell you this. The Fed has tried to be apolitical for a while, and I don't know when that stopped, but probably about 8 years ago when Trump was in office. And I can tell you that it got worse right before this election when they dropped interest rates 50 basis points in September before the election. No one talked about that. Those people should be all thrown out. They're not supposed to be political. That was pure politics. And so while you might not agree with Trump politicizing the Fed, they were already politicized. And I thought it was shameful what they did. You have to think about the fact that I think they did this to Bush too, when he was, they manipulated the rates, and Bush was not happy. So, I'm not saying it's a Democrat versus Republican thing. I just think if you're going to be apolitical, you got to be apolitical. You got to be across the board. And I think they've shot themselves in the foot on that. And getting a little refresh in the Fed board would be a good idea. But that being said, they're going to need to drop rates at some point because it'll be so obvious that they can't avoid it. So that's going to need to happen. And in May, we're going to get a new Fed chair. We'll see what he can do. But you still got a bunch of votes, but that's going to be important. So I think we're going to see an interesting year. If we have a flat year for the most part, then you're going to want to explore fixed income. I know everyone says the dollar is going to go down and, interest rates are going to go up and blah, blah, blah. I've heard it all. But if you look at the fixed income, it really hasn't moved all that much. And the dollar is still kind of going sideways, despite everyone thinks it's going to go to the floor. I just look at price. You could be as smart as you want on these things, but the reality is the price is the price. And whatever your theory is, if the price proves you wrong, it means you're wrong. It means the market is not respecting your opinion, and you need to move on. You need to change your opinion to align with the market, because the market is what's right, not your opinion. You can be intellectually correct, but if the market says otherwise, it means you're wrong. And that is one of the hardest things for investors to learn, is the fact that you could be intellectually correct. You could know everything you know about an industry. For instance, you could be in the gold mining industry. You could run a company. You can know the exact numbers of every of your competitors. You can know where all the inventory is. You can know all the numbers, right? More than anybody else on the planet. And you think that metals are going up, and then they start to go down. It means you're wrong. It doesn't mean that you're incorrect with your intellect. It means that you're wrong because the price is going the other way. And if you don't reconfigure your thinking around the price, then it means you're stupid. Okay? Because if you see an equation that says 1 + 1 = 2, and you're like, no, it equals 3. You're like, well, clearly it's 2. No, it's 3. And then somebody proves to you it's 2, and you're like, oh yeah, okay, I understand why you did that. And you keep saying it's 3, it means you're stupid. Right? At some point, you need to reconfigure your understanding of reality, right? If you throw a ball up in the air and it comes down every time, you think there's gravity, right? And everyone says there's gravity. Well, if you say, no, this time it's going to stay up there. But that's what people do in markets, right? Is their ego takes over and they say, I came up with this thing. I can't wait to be right. I'm so special. I'm going to prove everybody else wrong. You can't bring emotion into it. And the worst thing you can bring in is ego. When you bring ego into your investing, it is the worst thing you could do with investing. Everyone has this problem. I have this problem. Doug has this problem. What we try to do is we try to subvert our ego and shove it under the carpet so that it's not being used. Everyone has this problem. We are human beings. You have to fight against it, but it will wreck your performance more than anything else. Now, I bring this up for this specific reason. Everyone's been investing in tech for the longest time because it's been a no-brainer investment. If I'm telling you that tech will no longer be the best thing since sliced bread, and I show you, hey, look at this performance. Tech is underperforming. All these other things are doing well. And oh, by the way, we've got all these other things to support this. And I could be wrong, right? I could very much be wrong. I don't know the future. But if I'm looking at this, 1 month, 3 months, 6 month, 12 month, year to date, what's not doing well? Information technology. These are all down here. And you say, well, I'm going to keep all of these across the board. Well, I'm going to keep investing because I'm going to buy the dip. Good luck. You know what, people, you want to know if you want a good lesson in what buying the dip will do to you. If you haven't been following crypto, I can assure you should go on X and you should follow all the memes on crypto, because Bitcoin dropped approximately 50% so far. Bitcoin is approximately 50%. Okay. So if something drops 50%, you're like, oh, I can't wait to buy the dip. For the last 3 months, I've been hearing buy the dip, buy the dip, buy the dip. You know what? It keeps going down. At what point are you going to say, oh crap, I was wrong? Honestly, if you don't know, then you're not an investor, you're a gambler. You need to have an exit. Say, I was wrong. Otherwise, you're going to be down 80 or 90%. Now, in historical context, Bitcoin historically goes down 70% in a correction. 70. That's normal. We're down 50. We still got 20% left. Or in a greater context, 50% from here. Okay? Or approximately 50% from here. So about 40% from here. So if you buy today, you could drop 40%. Even though, you're not at the 70. 40 more percent. Do you want to do that? I don't. So at what point do you determine that you're wrong? You need to understand what that is. I'm not going to sit here and tell you, because there's an infinite number of decisions you have to make. But I can tell you, I'm not buying crypto here. I'm just going to wait for a bunch of reasons, which we can get into another time. But there's like volatility and other things. There's a whole bunch of reasons why I'm not buying, Bitcoin here or crypto or Ethereum or any of these others. I'm not against it. We still own some, but it's like the lowest position I could possibly have, because I know that it's probably going to go down further. Now, if it hits my target down 70, I'll probably start to acquire. I have this game plan mapped out because that's how I invest. I've got a game plan. And if it doesn't go according to my game plan, I got to either change my game plan or move on to another investment and just say, all right, this isn't working. Let's go somewhere else. But I've been investing in Bitcoin since 2017. And you could do that through some closed-end funds. And I've been doing it since then. I understand the cycle. I'm not emotional about it. I know it goes up 100%, 200, 300, whatever, and it goes down 70. Okay. I understand that cycle and I'm okay with it. And I'm going to wait until I start to see a reason to get back in. And if it spikes from here, I'm okay missing it. I don't need to be in every move. And I think we all get caught up in that emotion of we need to be in the hot thing. No, you don't. You can ignore it from here. I can ignore it for a year and I'll probably come back at the end of the year and be like, all right, so it's a good time to buy. Like no one's, it's down. No one's paying attention to it. So when you're thinking about your investing, you need to really think about how do I know, like, at what point am I wrong and how do I know I'm wrong? It's a really important thing to ask yourself for any investment you have, every single investment. At what point, like, how do I know I'm wrong in this investment? And do I get out? Do I add? Like, you need to understand all those things going in. Because if you just invest and be like, oh, cool, it's low, it could go down more. You have no idea. Now you're freaking out because you lost 40% of your money and you could have just, put a little bit in, if you're going to put in 5%, maybe only put in 1%. And you're wrong. Okay. I know it'll go down another 40% from here. I'll just wait and put a little bit more in. I mean, whatever the strategy is, I don't care what it is. You have to come up with that. But ultimately, you need to have this game planned out. Because if you haven't thought this through, then you're gambling. This is why investing is so hard. And I know I'm throwing a lot at everybody today, but this is why investing's hard. I've been doing this 26 years. I'm still learning stuff every single day. There are people who work for institutions. They're so brilliant. And I constantly learn new things. Okay. I feel like I'm good at this. I got a lot of experience, but I'm still learning new stuff. The market is so deep, so complex. You're never going to learn everything. The best thing you could do is, subvert your ego and just, they call it a beginner's mind, right? Come into everything with a beginner's mind. I know nothing. What can you teach me today? That's how you should look at it. Because if you let your ego take over, you're gonna lose more money than you're gonna win. But if you don't have an ego, you could very easily adapt. You could very easily say, you know what, I was wrong on that. Let's flip the script. Let's go a different direction. So we have, clients of mine know this. We have what we call, I'm going to use this framework and I'll pass it back to Doug. We have what we call scenario-based thinking. Now, I'm going to share this as an important framework. There are two frameworks that people use. One is what we call outcome-based thinking. Another is scenario-based thinking. Now, outcome-based thinking is how our brains are all wired. Every single person on this planet is wired as outcome-based thinking. If you think you're different, you're not. What's the weather going to look like tomorrow? I'll bet you can give me an answer. That's outcome-based thinking. What's your favorite sports team going to do? Outcome-based thinking, right? Who's going to win the election? We predict the future every single day in what we do, right? That's what we do. Our brains are trying to predict the future. And you know what? We're all really bad at it. We are probabilistically terrible at predicting the future. Yet we do it all the time. So if you're bad at it, why would you continue to do it? There's a solution. So instead of being outcome-based thinking, you should be scenario-based thinking. Now, here's what scenario-based thinking is. We have an election coming up. Who's going to win? Well, let's take the last election, right? Well, what are we going to do if Trump wins? What are we going to do if Kamala wins? Or what are we going to do if it's unclear, right? There's a toss-up and there's a big, mud fight and we don't know who's a winner. You have to look at all those scenarios. Those three were reasonably probabilistic scenarios. And you have to look at them. And if you don't have a game plan for each one, then you're guessing. You're saying, well, I don't care. Trump's going to win. I don't have to worry about the other ones. What if he doesn't? I'll give you an example. George Soros, when Hillary was going against Trump, George Soros bet big on Hillary winning. I mean, huge, like double down, triple down, like leverage bet. And he was like, it's a no-brainer. He's never going to win. And he ended up losing, like, I think it was $1.2 billion in that 24-hour period when Trump was basically elected.
Sorry, Kirk, I have to interrupt. See my small violin that you can't see where I'm playing for him.
Yeah, we're not losing any sleep over Soros. He for some reason he's not in the Epstein files, but he's probably an Epstein of his own making. So yeah. So anyway, so he lost $1.2 billion, and so what he did was he reversed his bet because he had a game plan if Trump won, right? And I don't know what it was because they don't tell you these things, but it was very clear he lost a lot of money in Hillary, and then he flipped the script and went to his other game plan because regardless of what you think of the guy, he is one of the best traders of our era. He's really good, and everyone knows it. You might not like the guy, you might think the guy's the devil, but he has skill when it comes to trading. Okay, so you have to acknowledge that. And so, in order to be good at that thing, you need to have a game plan for each scenario. So if I think we're going to bomb Iran this Saturday, I need a game plan if I'm right. If I'm wrong, I need another game plan for that because it's a different scenario. So rather than trying to predict outcomes, what you should be doing is putting together scenarios for each potential outcome that is reasonably probabilistic, right? Like I'm not putting together a scenario if we have a global, nuclear winter and the whole world blows up because it's not going to matter, right? My money's worthless at that point. So I don't care about that scenario and it's very improbable. So you have to think about what are the most reasonable probabilities and then how do you address them? That's how a good investor invests. If you're not thinking that way, you should start to work on that. It's hard. It's not easy, but work on doing it that way. And what's going to happen is your ego is going to kick in and you're going to say, I don't like this. This is not going to happen. Why am I doing this? You're hurting yourself. You're really hurting yourself with your returns because if you're not thinking about it in that way, then you're being closed-minded to it. And that means you're going to suffer eventually. So it's a skill to learn. It's a skill to work on. I've been doing this a long time and I can tell you I'm still learning it. I'm still getting better at it. I make mistakes all the time as everybody does, but you just have to learn from your mistakes and keep improving. And that's what we hope to do in this podcast is to help you learn and get better at these things. So what are your thoughts, Doug?
Yeah, so going back, you were talking about just later this year, and I want to just continue a little bit as a touch on the elections coming up. By the way, when you were talking about Soros and his success as an investor, I did want to say for anybody out there that is a gambler that has ever played the game of craps, Soros would be the guy at the table that's betting the don't pass line. I'm not sure if people are familiar with that, but most of the places that you bet in craps, you're betting with the person rolling the dice and you're hoping that they're successful. Soros is the guy that everybody doesn't like at the table because he's constantly betting against everybody else. And he does it very well and he tends to win, which of course, yeah, well, yeah, is exactly what they say about the people betting the don't pass line. So let's just be very clear that everybody else is high-fiving, throwing in, tips to everybody, throwing on chips. You're rallying, everybody's clapping. You're the asshole at the table that's betting that they all fail.
It's a good analogy, Doug. He is a dick. So it's a good analogy.
Yep, 100%. If you know craps, you know what I'm talking about. So going backwards to the, the year this year, I mean, as you said, Trump is trying to keep the core base, the power preservation. That's going to drive policy. Forget personalities. The base case, especially a controversial one, is simple for an administration. Maintain control, avoid censure, protect the majority, avoid gridlock that looks like failure. That incentive is going to shape every policy behavior more than any ideology ever will. Red weighting is political math. It's not policy idealism. The goal, consolidate the base, avoid alienating swing districts, avoid policy missteps that trigger midterm backlash. A little bit of a failure there, whether you agree or not with what was happening in my backyard in Minnesota with ICE. Definitely created more backlash going to the midterms, which caused a lot of Republicans to start to kind of distance and that's not what you generally want to see as the president going into the midterms. And that's why he softened his tone. And you saw some things recently that pull back on that. Fiscal decisions are going to skew towards visible wins. Painful structural reform is going to get delayed, and messaging is going to tighten around economic control. Standard political survivor behavior. It is not unique to Trump or any other administration. The other thing is going to be right now, there's been a lot of frustration that They have, and again, I'm not trying to get too political. This is just how it's the impacts, right? But there's been some frustration that you've got the Republicans running both the Senate and the House of Representatives and the presidency, and yet they haven't pushed things through that they've wanted to get done. So guess what's really going to be fearful is avoiding gridlock. That's going to become a strategic priority. The instant they lose one of those, the frustration becomes, not frustration anymore. It just becomes a real situation of gridlock. Markets, they actually tend to like divided government. If we run into gridlock, that tends to be good for the markets. As I think I've said this before, if you have a Democratic or Republican president and you have a Congress that tends to be opposite, it tends to be better than when you have them all the same. Voters hate dysfunction. Gridlock, if gridlock looks like paralysis, approval is going to drop. If it looks like stability, markets will stabilize. The difference is all going to be about narrative control. So expect targeted compromises, executive actions where Congress stalls, and tactical legislative packaging. Markets trade power stability more than the party. They don't listen. Again, it's about making money. They don't care about party color. They care about predictability, clarity, fiscal direction, regulatory tone. So if they feel there's a consolidation of power, that's going to be a short-term stability premium. Institutional instability is going to be a risk premium expansion. So that makes this year critical because control of Congress is going to determine how much fiscal direction can be executed. And what the midterms ultimately are is a stress test. They historically tighten financial conditions, increase rhetoric, freeze controversial policy. So if the administration believes maintaining maturity is at risk, guess what? You're going to start to see pro-growth optics. You're going to start to see targeted economic incentives, delayed austerity. That structural reform rarely happens in election cycles, but listen very closely. It's going to tell you a lot of what's going to happen. Debt reality is going to complicate everything, though. I want to come back to that. We've got power preservation colliding with record sovereign debt, massive treasury issuance, rising entitlement pressures. You can't stimulate aggressively without bond markets reacting. And as you said, Kirk, right now they kind of aren't. So the administration has to balance political survival with bond market discipline. The bonds, as you mentioned, tell you everything. And that tension is going to define this year. They also, you mentioned it, they want to avoid censure. Approval ratings, if approval ratings weaken, policy becomes reactive, tone becomes sharper, messaging is going to intensify, and the markets, we've said this time and time again, they don't love uncertainty. They also don't love paralysis. So expect volatility around rhetoric to maybe increase this year, not necessarily around actual economic substance. But gridlock could be a market stabilizer. Historically, it has caused markets to perform reasonably well under a divided government because big policy swings are unlikely, again, predictable. Regulatory extremes get muted. Fiscal shocks get diluted. If the midterms move towards a divided power, it could actually be positive, and the markets could price that in as stabilizing. So as a base case for 2026, nonpartisan, expect elevated rhetoric, tactical fiscal moves, no serious austerity, no sweeping reform, volatility into late summer, and stabilization if political control solidifies. That's going to fit typical midterm historical softness. So ultimately, the goal is power preservation. The economic constraint is debt discipline, and the market reaction is going to depend on who blinks first. So expect a lot of noise. Expect tactical stimulus optics. Expect volatility spikes. And don't expect sweeping structural reform this year. So if you're an affluent family, it's not a year to be overexposed to concentrated growth or ignore tax positioning or assume policy calm. It is going to be a year to start looking at guardrails, more diversification, tactical flexibility, and income clarity. Now, one thing I do want to add on this, you talked about doubling down on, if you've got, it is extremely normal emotionally to feel very vested when you believe something. And we've seen this. We saw this going into 2008. We saw this going into other financial situations, crises, etc. That people who are experts that make predictions, and this is also something to see inside yourselves, they tend to double down further and further, not accepting wrong. This actually goes back to a very well-studied phenomenon that Philip Tetlock put together called the Big One. He was a political psychologist that studied 28,000 expert forecasts over 20 years. Now, what did he find? He found that experts barely outperformed random guessing. And when they were wrong, they rarely adjusted their core beliefs. The worst forecasters were often the most confident and the most ideological. And experts with media visibility. So if you're listening to the Kramers of the world, or not to throw him under the bus, but anybody that's out there, often less accurate. And I think I've talked about this too. I know people that used to get called on those early morning, market shows. They would literally show up, ask them what their thoughts were, and the shows wanted to pick the most divided because that gets the clicks and gets it exciting, and they send all the normal guys, normal views back home. Philip's famous line was, "Experts were no better at predicting the future than dart-throwing chimpanzees." So the key behavioral finding is experts doubled down when wrong instead of updating their models, and he called this belief perseverance. We all face this. Cialdini and from behavioral economics, once someone publicly states a position, they are statistically more likely to reinterpret new data to support their view, seek confirming evidence, escalate conviction, avoid admitting error. Echo chamber, all the stuff we see in political and everything in social media. This isn't, there isn't a clean percent number, but multiple studies have shown that people that make these predictions significantly more resistant to reversal, and forecast confidence often increases after failure. That's an escalation of commitment. So just, there's more data behind this. So just beware, just like these experts. There's decades of behavioral research showing that when they make these bold predictions, statistically, they're going to double down more than admit error. Look inside yourself, but also understand that when people are listening to someone, that reputation risk drives an escalation of commitment.
Yeah. Well, I know we gotta wrap it up here in the interest of time, Doug. Where can people find more about you?
Excellent. Yeah, appreciate it, Kirk. Listen, it's going to be a year that you're going to expect to see more things come together as we work towards the elections, the election coming up. And history doesn't show that shows that experts don't usually fail because they lack intelligence. They fail because they lack flexibility. So when bold predictions are made publicly, psychology kicks in, reputations get attached, positions get defended. Instead of adjusting with new information, people double down. And markets don't reward that stubbornness. They actually reward adaptation. So right now, we're in a year where politics, debt, inflation, liquidity, and asset rotation are all colliding at once. That's not a moment for extreme conviction. It's actually a moment for disciplined structure. You don't need to predict the next recession. You don't need to predict the next rally. What you need is a plan that survives both. So for affluent families listening, especially, complexity is going to magnify your mistakes. Concentration risk, tax exposure, retirement, income timing, college funding pressure, all of it's going to get harder in volatile regimes. And that's why clarity matters more than forecasts. So right now is a great time to map your assets, to stress test your income, to build guardrails, rotate intentionally, not emotionally, because the markets are going to humble the experts. They always do. And the families who win are the ones that are going to build plans that don't require being right, just being prepared. If you want to learn more about being prepared and how to map all that together so that you have a solid structure that protects you from all of the unknown out there, check out our website, mergentadvisors.net. That's MERGENT, mergentadvisors.net. And I appreciate it, Kirk. Thank you. And I look forward to being back next time.
Yeah. Well, thanks for coming on, Doug, and nice to see you, sort of, today. We'll get your pretty face on next time. I'm
known as a person that fidgets, but I've been, as you can see on my image, I've been sitting very still today. My wife would be proud.
Oh, that's good stuff. Well, that's the show for this week. It's been fun. Now I got to go out and prepare for shoveling tonight. That's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here in the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a shorting and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.